Evergrande is a Chinese developer, and I'll just go ahead and read off of their website just to kind of give you a context because I don't want to misconstrue this. Uh, they're a real estate group, a developer, the second largest property developer by sales, making it the 122nd largest group in the world by revenue, according to 2021 Future Global Fortune 500. So that's one of the biggest developers. They are about to default on their loans, essentially. And a lot of this still has to do with Chinese regulations. We've seen, right, like Baba, Pinduoduo, a lot of the Chinese big players, large cap tech stocks in particular, have been just decimated over the last, 6 months, essentially. You remember, we had free Jack Ma shirts for crying out loud, and now it's seeping into the real estate market in China as well. And we could see a potential collapse. We could see a repeat of the Lehman Brothers, if you guys recall that in 2008, 2009, when they just went belly up, happened in, happened in China. So that's obviously impacting the Chinese markets, which the Asian markets over the weekend just went crazy. They sold off wildly. And it's seeping over into the U.S. markets. Why, though? Why is it coming over into the U.S. markets and impacting us? Why do we care about the real estate market and developers over in China? Why does this matter to the U.S.? And one big thing that it impacts as far as the stock market's concerned in the U.S. is the commodities. If you guys haven't noticed, iron fell, steel fell below $100 a ton for the first time in a while this year, I think. So we saw commodities really kind of take a hit. Cleveland Cliffs, you guys know it's a frequent flyer here on Own the Chaos. I actually own this. I own calls of it now. Thankfully, they're far enough out to where I think that I'm just fine with it. And I was actually considering adding to today. And we'll get into what I might actually be adding to and what you may want to consider adding to on this dip. And I do think it is a dip. So anyways, they're defaulting. It's impacting a lot of the raw materials that we export to China for their developing needs and real estate and all that good stuff. So that's one thing. That's the big headline. But what are some of the other underlying things? And that's what's happening. So we're seeing, obviously, this is one thing that tipped the scales, and that's what's making the news today. But there's a couple other things. We have the Fed meeting that's coming up. There's this inflation fears that are still looming. Everybody thinks that the Fed's going to just all of a sudden react and have a knee-jerk reaction to inflation, which I don't think is going to happen. Fed Chair Powell has not led us to believe that he's going to deviate from anything that he's already set out to plan. So the Fed meeting's this week. It's on Wednesday. We'll see what happens. I don't think that there's going to be any surprises, I should say, that they're going to speed up the timeline with any kind of velocity that they've already talked about. So that's definitely something that you may want to also just look at. Like, here's the thing. You have mainstream media, you have, a lot of people on social media, these analysts with institutions trying to make arguments for inflation. And whether you believe inflation's happening or not, okay, whether you believe it's, I should back up. It is happening. Whether you believe it's transitory or not is the bigger question. And if you don't, it doesn't matter because the Fed's still going to be the Fed. And everybody, there's that age-old cliche, don't fight the Fed. And yet everybody still wants to fight it. So for me, I've been trading based off of what the Fed's been telling us. So I don't make all of my trades that way, but I'm going to continue to follow what the Fed says because I'm not going to fight them. So you could make all of the speculations you want as far as what the Fed's going to do, but the Fed's been pretty honest, and everything that they've said that they're going to do, they have done. So I don't know what anybody else has to really bring to the table as far as the Fed's concerned and why we're even worrying about it, because the economy is rocking and rolling and inflation isn't going as crazy as it was. We saw the CPI numbers from last month in August. They actually came in much better than expected. And so, look, inflation's happening. It's going to be a thing, whether it's transitory or not. Again, that's a separate conversation for another day. But the Fed's going to do what they're going to do. And why fight that? Why try to push against it? Because it's done nothing but beat us over the head with, as far as that's concerned. Really, it just doesn't, it shouldn't impact the way that you trade. It really should not. Follow the Fed, don't fight the Fed, and you'll be just fine. The other thing is, there's, like I said, look, there's a lot of things that are going on. The other thing this week is the U.S. Is set to vote this week on the debt ceiling and a stopgap spending measure that may, bring on some volatility in the markets as well. If we don't raise the debt ceiling, we got a lot of decisions to make as far as the Congress is concerned. I say we, but they have a lot of decisions to make. And, we'll see what happens as far as that's concerned. At the end of the day, Congress is not going to let my best guess is that they're going to raise the debt ceiling because they don't really have another choice, in my opinion. They really just don't. It's either that or crash the market, So I don't think they're going to let that happen. Whether you like that or not, it's neither here nor there. I think that's just going to be the case. And then, so you look at that and you're like, well, is that really going to be a big deal? No. Fed's going to do what they're going to do. Does the issue with Evergrande really impact the U.S. markets that much to yield this kind of reaction? I don't think it does. And so I do think that this could be an opportunity to look for stocks to buy for a good day to try to at least make a list of things that you want to buy. And I don't know if today is the day that you buy, because I've added to one position, and that was my 4 position, and it was a very small amount. Didn't really move the needle as far as what I'm leveraging, but I just wanted to see how the market was going to react after I ended up adding to Ford. I will still be planning to add more to Ford, and we'll kind of see how that plays out. But the big key here is a lot of people that'll be like, oh, just buy the dip, buy the dip, buy the dip. The other thing is you have to buy the dip smartly. You can't just take all the cash you have and toss it at whatever it is that you're looking to buy. At least in my opinion, this is how I do it, right? I'm not going to just go in all crazy as soon as I see the first red day and be like, oh, buy the effing dip. We'll be good tomorrow. Not always the case. We could see, for the reasons that I talked about with the House vote and the Fed meeting today, we could see some more volatility. So while today is a really red day, I mean, I'm looking at the Dow right now. It's down almost 1,000 points. I'm down 10% in my portfolio. My whole account's down. So I'm not freaking out. And I think that's obviously the biggest thing, but going all in on day one of a correction, usually it doesn't pan out. Trying to time the market, trying to figure out where the bottom is also typically doesn't pan out. So scaling in a little bit at a time, waiting for confirmations on a lot of various supports, no matter what you're trading, watching buying to actually return makes the most sense, at least to me.